ERISAfire is the special ops of health and welfare employee benefits compliance, serving employee benefits brokers and their employer clients. We offer you peace of mind that your compliance risk is managed holistically, even when the benefits environment is ever changing. We back our work with a quality guarantee and the assurance that our attorneys and paralegals will catch what others miss. We walk alongside you with continued compliance support to protect your business and help you succeed. Here's some of our practical, actionable guidance. Please enjoy this video from the ERISAfire archives.
Hi, everybody. Welcome to the 5th ERISAfire COVID-19 Town Hall. Wanted to thank you for taking the time to join us today. Just want to start with a few housekeeping items before I turn it over to our host. We have had a few folks who've had issues with the audio in past town halls. So if you have something pop up that says something about an unstable connection, consider dialing in by phone. The number is right there, and I will also send that out in the chat here momentarily. Because we want to have this be a conversation, town hall question and answer style, just wanted to make sure to show you where you can input your questions. If you go down to the bottom of the screen, click Manage Participants. First start by clicking Rename by your name, so I can call you by your name and not iPad number 2. And then you'll see next to Manage Participants, just 2 over is Chat. The default is to everyone, and please feel free to chat your question to everyone, and I'll be keeping track of any questions that come in there or privately, and then I'll be calling on whomever it may be, and we'll unmute you at that time. We've been talking a little bit at the beginning about a Bloomberg Law article that David wrote about furlough during a crisis like this. And if you're interested in receiving a copy, please just send me a private chat here on Zoom with your email address, and I'll make sure we get that over to you. And we'll take care of that. So without further ado here, for those of you who do not know David, he's the founder of ERISAfire Benefits Compliance Solutions and managing attorney of Lefevre Law PC. He's been an employee benefits attorney for 13 years. His practice focuses on assisting clients in complying with ERISA and other employee benefits laws pertaining to health, welfare, and retirement. He is a contributing author to Bloomberg Law, Benefits Link, among other publications. And I'll turn it to you now.
Good morning, everybody. It is Tuesday, April 21st, and it has been 92 days since the first case of coronavirus was detected in the United States. We have a few things to talk about here today. And again, like our usual format, we're going to throw some topics up. We want this to be as interactive as possible. So if you have questions that have come up during the week and you'd like to get some answers, this is one of our ways to give back and just provide advice as best we can here in the moment. And so if you have questions that have arisen, please feel free to ask. Just chat them in, and periodically through the program, we will field some of those questions. To get the creative juices flowing, though, we've got a few topics we put here up on the screen. There have been some interesting developments, both on the FFCRA front and the CARES Act front, plus a hidden federal balance billing ban that was kind of interesting. And a quick look into the crystal ball about what renewals might look like in the fall. And then we're gonna talk to a special guest today about the medical TPA's perspective on things. So if you have questions along those lines, please feel free to chat them into the program. We'll cover just a few things here just real quick that we found interesting. And all right, just a few things we found interesting. First, a few words on the federal Families First Coronavirus Response Act coverage mandate. One of the things I found particularly interesting was that the testing mandate includes not just a test for active virus, but also the serological test for testing antibodies. That's going to be really, really important. And you may have heard or read some news about antibody testing recently. And the reason it's coming up is because, particularly in the South, we've got a few governors who are trying as fast as possible to get their state economies reopened. And one of the keys, say the medical professionals, to opening up a state or a locality is having widespread testing, including a serological test for antibodies. So interesting development, because particularly for your self-insured plans, the testing mandate under the FFCRA will include antibody testing that government officials are trying to roll out on a widespread basis. So that's a lot of testing that the federal government is expecting insurers and self-insured employers to cover. Interesting development there. Second interesting development, there's been a lot of additional guidance under the CARES Act that included a whole host of things meant to assist people and to help the United States fight this virus. And one of them is an expansion of telemedicine or telehealth. And the charge has been led by Alex Azar at CMS. CMS has primary authority over Medicare. But historically speaking, as Medicare has gone, so have insurers. And a couple of really interesting things that no doubt some entrepreneurs are jumping on top of. First, again, this is through CMS, so it applies only to Medicare at this point, but could be the carriers. No video is necessary. So you think of Teladoc and other similar services that provide video conferencing. CMS has relaxed the requirement and is allowing not just no video, so you're talking a phone call, right? But also residents can provide care and bill for it under Medicare. And treatment can be provided virtually. So again, no video, over the phone from a physician's home. So blowing the doors open on what is possible to be billed as a covered charge under Medicare, and in particular and I'm just thinking of this, reference-based plans typically will reference, if something is covered under Medicare, it'll be covered by the plan, it'll be covered at, whatever, 120, 150, 200% of Medicare, whatever the case may be. So or out-of-network claims, it's not uncommon for the major medical carriers to include provisions in their insurance policies that says if an out-of-network provider submits a charge and it's covered by Medicare, then it's going to be covered at whatever percentage under Medicare for an out-of-network claim. So that kind of blows the door open on what's possible to be billed as a covered charge. And if it's COVID-19 related, potentially without cost sharing. Very interesting stuff. I'm going to pivot here for just a second. So we talked about no cost sharing and COVID-19 coverage and things like that. In an effort to kind of expand this protection of the consumer, if you will, by the federal government, and so along these lines, we're talking about waivers of cost sharing, co-payments, deductibles, et cetera. HHS has also put some purse strings on the money that it's sending to hospitals. All right, zoom out for just a bit. If you haven't been following the news, one of the things that's tripping up the expansion of the SBA's Paycheck Protection Program and potentially the Economic Injury Disaster Loan Program is a fight between Republicans and Democrats in Congress on the issue of basically just sending as much money as possible to hospitals and providers. And so HHS is charged with administering this program. And so it's been partially rolled out, I believe, to the tune of about 20 billion. There's supposed to be more in a piece of legislation that we hope will be passed today or tomorrow, with additional funds for hospitals and providers who are just being decimated by this virus, particularly on the coasts. And in there, though, is a purse string. And HHS included this little line in the terms and conditions that a hospital or a provider has to sign in order to get access to these federal funds. And this provision says that it will not, that the hospital promises it will not balance bill anyone who is treated for COVID-19. Okay, so treated for COVID-19. Then some guidance said, that means, by the way, a presumptive case of COVID-19, presumptive case meaning you don't have a test, but you do have symptoms, and a diagnosis based on symptoms. So presumptive cases. And then some additional guidance said, oh, by the way, we consider everyone, every patient to be a potential COVID-19 patient. And that raised some alarms. So what was interesting, so HHS, just think about this for just a second. If you've been following the balanced billing legislation, both on the state and the federal level, there's a wave of legislation on the state level. My home state here of Texas passed it. It was effective January 1st. Other states have been more proactive and enacted them earlier. Others are coming online. That only deals with fully insured plans. ERISA preempts self-insured plans, and states can't regulate that. A lot of employees in America get their health insurance from self-insured health plans. And as costs have gone up, the number of employers moving to self-insured health plans has increased, and the size of an employer that implements a self-insured health plan has come down considerably. So a tremendous number of people are not going to get the benefit of this state level balanced billing or surprise medical billing legislation. Congress has been debating this for a while. And what has been truly remarkable, and I was in Washington, D.C. in February to talk to some legislators about this, truly remarkable is that there is bipartisan support on the federal level for surprise medical bill legislation. Bipartisan support. The number of co-sponsors is tremendous. And yet Congress has failed to pass any legislation. So the federal agency HHS, no one was elected at HHS, just appointed, decided to implement their own balance billing ban, it appears. It raised alarm bells pretty quickly, and it looks like HHS may pull back on that very last statement that all patients are considered potential COVID-19 patients. I suspect that in an effort to get things done, probably overstepped its bounds a little bit. And in fact, some medical provider groups, physicians groups mainly, have threatened to sue. So I'm expecting that to get pulled back. Nevertheless, at least for presumptive COVID-19 cases, so presenting with symptoms, it does look like there is a balance billing ban, which would be something that if you have a self-insured health plan with out-of-network claims, or if you have a reference-based plan, protecting your employees from balance bills is a concern, and it's one of the reasons why some employers haven't gotten into the reference-based pricing arena yet. That may be something to take a look at. So very interesting stuff there. Let's see, I'm going to save some of this other stuff for maybe the bottom part of the hour, because I want to make sure we get to our guest today. But first, a word from our sponsor.
Hi, I'm Aaron Richard, Solutions Navigator at ERISAfire, the special ops of health and welfare employee benefits compliance. Thank you for taking the time to attend our COVID-19 Town Hall. Your dedication to educating yourself amid a crisis shows your genuine concern and compassion for your employees and clients. For that, we thank you. During this tumultuous time, ERISAfire offers peace of mind that your compliance risk is managed holistically even when benefits compliance is ever-changing. That your quality of your compliance work is guaranteed because we're thorough and we spot compliance issues that others miss. And a personal touch because we care about you and your success. So whether you have a tricky compliance question, need annual ACA reporting or Form 5500 filings or a plan document update, we're here for you, both now and in the future. For more information or quote, contact me at aaron@erisafire.com. Now back to our regularly scheduled program.
Thanks, Aaron. Appreciate it, man. As y'all can tell, we're having some fun with this. But all right, so now on to our special guest today. Here with us is Jack Stevens from National General. He hails to us from Kansas City. So congrats, Jack, on the Chiefs Super Bowl win. It's been
Thank you.
rather fashionable here in Texas to be a Chiefs fan because of the Chiefs quarterback, of course.
Sure.
So Jack, just a little bit about Jack here. He received a degree in economics from the University of Kansas, which opens the door to a wide array of MU Tiger and KU Jayhawk jokes, but I'm going to leave those alone. For 7 years, he worked in logistics as a freight broker with Command Transportation. In 2017, he joined National General, where he supports over 300 brokers, advising agents and business owners, and educating them on the evolving legal and competitive changes to healthcare in his market. Jack, welcome to the program.
Thanks for having me. I appreciate it.
So just a couple things here real quick. So tell us just a little bit about National General and you work primarily on self-insured cases, right?
Mm-hmm. Yeah. So the soapbox there briefly, National General actually used to be Assurant, which might ring a little bit more of a bell. Assurant dabbled in fully insured and level funded policies for some time. And when the ACA came out, that kind of sunk that ship a little bit, to say it nicely. So in 2015, the health and the A&H side of the house was acquired by National General, which is a holding company. It's publicly traded, trends around $5 billion annually. So we've got our hands in quite a bit on the property casualty side, a number of holding companies a part of that. What I primarily do day in, day out is major medical employee benefit platforms for small to mid-sized businesses. My niche is 2 to 50 enrolled.
Got it. So that's an interesting point. And some folks here may not be as aware of that as we are.
Sure.
So there does appear to have been a shift from a self-insured case. Shoot, if I go back maybe 10, 15 years or so, a self-insured case, you probably wouldn't talk to an employer about self-insuring until they get to like 500 employees.
Sure.
That has totally changed.
Right.
And things have changed drastically. And now the number of employees where it starts to make sense to self-insure is a whole heck of a lot lower. Mm-hmm. So that has huge implications. And there's a lot going on. There are rapid changes in what the federal government says we're supposed to cover and how. And Congress makes this proclamation from Capitol Hill, and things are supposed to turn on a dime. Typically, these plans have been sponsored by very large employers with a whole heck of a lot of resources. So what does it look like now for you as a third-party administrator as these federal changes are issued and expected to be implemented overnight? So what has National General been doing to implement these things, and how has it worked for employers of various sizes?
Yeah, so the biggest thing for the small group space is always going to be education. Most employers out there, they didn't realize that they could go the level funded. What we do primarily is level funding. That is a little bit different than traditional self-funding. Okay, so it's fixed cost, right? But they weren't always in tune that this option was out there. And we've had this product in historically composite rated states like Colorado or Massachusetts for 20 years. So when the ACA came about and we got acquired, all we did was pull the curtain back nationally, right? So we're in every state except for Hawaii. And it just comes down to presenting options to the client that makes sense, making sure that they know exactly what this product is, how it works, how the refund works. But benefit-wise, we structure our product to walk, talk, act, and feel like a traditional fully insured option. There are some level-funded carriers out there where they will, there's some pretty apparent loopholes with the product. But we've made a pretty hard push to not have a ton of drop-off between the traditional fully insured model. And with everybody, I think right now, and we kind of talked about it briefly before we started, with the current climate, everybody's got to pivot and adjust, and language changes, cost sharing changes as it relates to COVID, like you mentioned. So we value our relationships with our agents and brokers and our clients, their clients, above anything else. So we actively make sure that they know exactly where we stand. We've got a dedicated account management team behind them to support questions, and make sure that there's no drop off on the information side of it.
So let's talk about the claims administration side of things, because we have heard through various crowdsourced places, Reddit and Twitter, and just talking to people both in the healthcare industry and employers, that particularly maybe a week or so ago, some of the major carriers, who of course are in the ASO world, and they rent out their claims administration services and network, are denying what appear to be, at least from the provider's perspective, pretty clear COVID-19 claims.
Sure.
So do you have any suspicions about why that might be happening?
I do. And I don't think it's going to be anything that's overly shocking. You have everybody, like I mentioned, it's, kind of what we talked about previously was there's no standard operating procedure to this whole deal. Everybody is creating, updated contract language, updated procedures almost by the day, right? Or at least by the week. And you have to remember, a lot of times on billing, as it comes to claim codes or billing codes, there's a human error aspect to it. So somebody could be going in for a COVID related issue because of pneumonia, but maybe they're not seeing the overlap there. As far as I've seen, and I know we discussed it briefly as well, our cost sharing and anything related to COVID as it is treated has been handled accordingly in terms of it's all been waived, right? I've seen the instances of, property casualty and commercial insurers where, you've got a storefront that's closed and they've been a little bit stickier in terms of wanting payment on that stuff. But we've had a ton of flexibility of that. And I haven't seen much denial of claims, but it's still kind of early to, in terms of the whole process.
So that's interesting. So I was just thinking about something that, as I was talking earlier about presumptive COVID-19 cases, and those are cases that present with symptoms, but there's not an affirmative test yet.
Sure.
And if folks here have been following the news really at all, testing in the United States is way behind many other countries in the world, way behind. So recently there was a study in Santa Clara, California, I want to say, that where they did implement some widespread testing and found that and this was the serological antibody test. So presumably it was billed to insurance somewhere and got covered.
Right.
But citywide antibody testing, and this study found that almost 80 times as many cases in the population than had been reported previously. So what that tells me is that the number of presumptive cases, that is presenting with symptoms but not an actual test, is probably enormous. And just, I'm not on the medical billing and coding side, but I know a little bit about it. If somebody, there's no diagnosis code that I'm aware of that says COVID-19 that's in everybody's system, is there?
Sure. No, there's been a couple codes that we've highlighted as, the cost sharing would be waived, but in terms of answering them directly, there's not yet. I think there will be, but not as of right now.
Yeah. Okay. So that means people are presenting with symptoms and pneumonia, and as much as I might not want to defend the insurance carrier industry, I will and step into their shoes and play devil's advocate here. Okay. So I've got this massive software system, and I'm renting it out to self-insured customers. I'm using it for my fully insured customers, and all it says is pneumonia. Do I then change the system so that every pneumonia case is covered without cost sharing? What's that going to do? Will that bankrupt me as an insurer? And so I'm wondering if this is happening in large part because there is no standard operating procedure, and we're dealing with primarily presumptive cases and not confirmed cases,
Sure.
requiring, so does that require that there be a real hands-on human element to processing these claims?
Yeah, and I think eventually there's going to have to be something where certain codes either have to be created or have to be adjusted, where it streamlines the process. Because I read an NPR article the other day, and there was another law firm where technically, if you really splice it, anything can be COVID related, as a broad brush. So I think it's up to the providers, and it's up to the insurance carriers, and it's up to the members, making sure that they're reconciling those claims correctly and they're getting as much in writing as they can. They're looking at everything, and that's a similar thought process as anything. My wife and I, with our daughter, I fought some claims on the pregnancy, that they were maybe trying to sneak in or not assume we would take such a strong look at, but I'm on the insurance side, so we did. And that exists everywhere. So I think you're going to see some patterns that overlap as we move along here, and once this becomes a little bit more commonplace.
Interesting. Okay. So for the HR folks who with self-insured plans or level funded plans that might have a little bit of control or visibility into their claims, even large fully insured cases have a little bit more visibility into claims. And they are going to be experience rated to some extent, perhaps a large extent. So for the HR people in the room who are hearing that, oh my goodness, there is no infrastructure in place for doing what Congress ordered the country to do as far as this whole cost sharing thing. What is an HR person to do? Like, so let's say we've got an enterprise who's big enough to have somebody that's a benefits specialist and can dive into the claims issues, maybe help some employees out, or they're just trying to manage their exposure so that, providers don't go, great, everything is COVID-19 or a large portion of COVID-19. And that's without cost sharing. Awesome. Let's get that covered because I can't get blood from a stone. So what are they to do? What's the best thing that an HR person could do right now, given all the constraints on time?
So, and this is short-term and long-term, and I think should be done everywhere. You have to, and you have to pull your plan document, your SPD, right? Every carrier on every major medical policy is going to give you both. The SBC is going to give you the general skeleton outline view of what is in there. The SPD is going to be the meat. It's going to be the details of it. It's going to list covered charges. It's going to list exclusions, and you have to highlight those and you have to get familiar with them. There is just generally, there's a consistent lack of education on employers, employees. The more information that can be out there and the more education that can be gained on what the product is, whether it's fully insured or whether it's level funded or self-funded, what the benefit structure is, what those exclusions are, hammer that, go through it and ask questions.
All right. So step one is to be prepared, right?
Correct.
So we're fielding questions from employees who have heard in the news, because it's broadcast all over Kingdom Come,
Correct.
Right? That there shouldn't be any cost sharing. And so we have a claims dispute, or the employee just calls with a concern. So step number one is to be prepared and familiarize yourself with the SPD. And for folks that know that we do SPD reviews, this was not a plant. I did not tell Jack to say that. But yeah, so those documents become incredibly important because that is the crux of whether something gets covered or not. And it's the language in those documents. All right. So number one, be prepared. Is there anything an employer can do to be proactive to get ready for the potentiality that these claims get denied, or that there's just, like you, I don't think that the denials are a function of, I just don't want to cover this. I think it's probably, there's a time constraint that a carrier or a TPA has to make a decision on a claim. And if we don't have all the information to see which bucket it goes into, I suspect that they're going to deny the claim for maybe insufficient information to buy some time, because then you get into the appeals process or the provider resubmission process, which buys them a little bit of time, both under state law and under ERISA. So they're buying some time. Is there anything an employer could do like for instance, if I were one of your customers, could I get a report that tells me, hey, I need to know who what claims are being filed that could be COVID-19 related? Is that something that an employer could do?
Yeah, and the easiest part there would be, get with the carrier, whatever carrier might be, us or anybody else, and get their COVID language. Everybody's updated it, at least once, if not multiple times at this point. Get their COVID language and get the billing codes that are going to be covered as with cost sharing waived. Right?
Oh, that's interesting. Okay, so from carrier to carrier, it might change as to the actual billing codes.
Absolutely.
And so that will give you a pivot point once you've got those codes. If you have, an employee come in asking about how come one, it was denied, or two, I'm paying cost sharing on this and I shouldn't. You've now got that list of codes and you can pull the claims data specifically for that individual, right? That's an easier report run. And you can see the billing codes, and I got you. Okay. And see.
So the example I'll give you there is, we've waived cost sharing on Teladoc and telehealth, which are two very different things. Teladoc is a company that does telehealth services, and telehealth in general is just virtual visits.
The broader concept.
The broad brush it, right?
Yep.
And what we've done on the telehealth side is, if you don't have Teladoc as a buy-up option that we can include on our plans, any claim with the service code 02 related to diagnostic testing for COVID will have all cost sharing waived. So familiarize yourself with your carrier and their specific language as it relates to COVID, because it's out there. It is 100% out there, and they'll work with you. It's not like anybody's going to try to withhold this information. It's just, it's up to the group and all parties involved to make sure that everybody's on the same page.
Got it. Really interesting stuff. Okay. So, I hate to put more work on the plates of very overworked HR people, some of whom have to also educate their kids at home while this is all going on. But one of the things that is not going to stop is the need to file claims, the potentiality for appeals. ERISA has not been waived. Its standards of fiduciary conduct still exist. It is still actionable and is still on the table as far as, I think people are going to give each other a little grace, but it's hard when you're faced with a balanced bill of however many thousands of dollars to say, oh, we'll work it out later.
Right.
So yeah, interesting stuff. Pivoting here just a little bit, there are a lot of folks who are concerned that with these new coverage mandates, either ones that were kind of semi-automatic, that is opt out from the self-insured or level funded side, or that are automatic because of state mandates for insured plans, that this is going to result in some really big unsightly renewals. If you could peer into your crystal ball for National General's, let's say, level funded customers, which is it's a hybrid between insurance and self-insurance. It walks and talks like insurance, but still has a self-insured element. What if you could peer into the crystal ball? What is that going to look like in the fall? What's it going to look like next year?
Right. So to peel that onion back a little bit, I'm going to take almost 2 steps back. What we do as a level funded carrier against traditional fully insured, those are the 2 main options, again, using a broad brush, right, from 30,000 feet. Traditional fully insured is no underwriting, no refund potential, okay? Level funded, everything that I do is fully medically underwritten, where we go in and we look at claims. There's a 5-year look back. We have all members fill out an application. We look at conditions, we look at medications, and that's how we assign risk, okay? Those are the 2 big differences. And our policies come with refund potential. I don't sell groups on refund potential. It's more of a cherry on top. But because we can customize plan selection as opposed to canned options where it's kind of take it or leave it, pay and pray, as some people call it, we put groups in the best position possible to receive a refund. So the reason why I bring that up is inherently how our block of business has been formed is we've taken groups out of those ACA pools, out of those traditional fully insured pools, and we've now underwritten them, and they're a part of our block now. So just by design, our personal block, it's not really full of the 50-year-old plus pre-X stuff. We have some, 65 years old and older. We don't really have some of those higher risk niches just because we're a level funded carrier and we underwrite off medical conditions. So our block as it stands right now, it's gonna see some pushback, but it's as far as it's been explained to me and the pulse that we can keep on it, it's healthier than normal. Now this can affect healthy and unhealthy people alike. I think we can agree on that. It's primarily affecting more with pre-X and pre-existing conditions. So you're not going to see from us, my gut is telling me, again, take it with a grain of salt, full transparency, you're not going to see a 40% renewal and 30% of it is because of COVID. You could see that from the fully insured blocks where their population base is getting hit higher. We're a smaller niche carrier, so our block is smaller just in general. So or you wouldn't see a 75% renewal and 50% of it is because of, or 60% of it is because of COVID claims. Speaking for me personally, I think that will probably happen to some carriers, maybe, but I don't know if as it relates to my crystal ball for our company, I don't see that being a huge talking point as far as renewals go.
So that's a really important point because as companies like yours have created products for smaller and smaller employers, it could lead to a fragmentation of the market, and
Sure.
If it happens on a very, very large scale, almost an insurance death spiral, right, for the insured market as
Sure.
Younger, healthier groups pull out, smaller and smaller younger and healthy groups pull out and go to a self-insured option. Full level funded, which is self-insured in my world.
Right.
But so one thing that you can do if you're looking at, if you're in the mid market where you might be 50% experience rated and 50% pool rated, it may be more attractive now to look at self-insurance for 1/1/21. So that's an interesting takeaway. For folks who are already self-insured or level funded, is there anything are there any steps they can take now to to get ahead of this a little bit? Because you're still, your stop loss is still risk rated. So there's going to be some exposure there. But is there anything a self-insured employer can do now to kind of prepare for what we anticipate to be maybe in some markets upwards of 40% increases?
Yeah, and that's going to be, I would try to pull, if they're self-insured now, I would try to pull as much reporting as you can. We provide reporting on our aggregate account. We provide claims reporting as well. And working with the carriers to see where they're kind of currently at, to see if you can ballpark it. But again, it's kind of the goalpost kind of moves no matter what lever you pull, because you could see some shock claims on there that are factoring into it that are outside of it. That's just kind of part of the insurance spectrum. But I think the first step that I would take is pulling where I'm at claims wise, where I'm at performance wise, where my loss ratios are at, and trying to get an idea. The option is if you are going to trend towards a renewal like that, I don't think most people on the carrier sales side are going to tell you, but that you're going to get enough data where you're going to get a fairly decent picture of what that's going to look like. And maybe you historically just didn't shop or didn't move much, but maybe you go to market this year. And if that in fact does happen where you get that nasty renewal, go to market 60 days prior, go to market 90 days prior, or now if you want. And if you get that nasty renewal, then you can take a counter offer or multiple offers back to your incumbent carrier and say, hey, look, this is what the market is showing where we're at. And I think you're going to see a lot of groups continue to shop like that. And you've already seen it where a lot of groups are moving every year, every other year, where historically it was a 10 or 15 or 20 years, or they just never moved.
Yeah.
And
So in particular for larger employers,
Mhm.
it's my experience has been it's easier for smaller employers to pivot insurance carriers or TPAs almost every year. Larger employers, it's a whole lot harder to do,
Right.
particularly if it's more white collar.
And I'm always biased because everything I do is in the small group space. So I'm always going to give you information
Sure.
through that lens.
And I'm thinking, but just thinking back on the employers we've worked with on the self-insured side, employers with 1,000+ employees. I'm just kind of sticking my finger in the air. It's almost like once every maybe 5 years that they consider going to market. And so maybe one of the takeaways is, let's, when we can find some time amid the leave implementation and all this other stuff, and the pestering from the Treasury side for tax credit information.
Sure.
If we can find some time to maybe work with your insurance broker about getting ready to take things to market, and getting those reports pulled, because I know it happens a lot, even in larger organizations, where the negotiation, the act of going to market can actually bring that renewal down. Right. Even if you don't change carriers or TPAs, but it takes, in order for that threat of a move to be legit, it has to be more than just, oh yeah, well, we're going to take this to market. You have to actually go through the process of pulling the claims data and running the reports and approaching a couple of people. And
then you could even have the instance of, maybe the claims data that you pull 90 days prior looks good, but you still have 3 months of that contract left. And you do have some exposure there where you could see a couple, 2 or 3 of those months turn south, and then that's going to affect you as well. So I think the general broad brush on my end is just continuing to familiarize yourself with your policy, with your plan, with the information that is given to you from the carrier, and using that as a tool and as much leverage, again, full transparency, as you can. Yeah, that makes sense. So there was one other topic I wanted to bring up here, and it's the growing popularity of reference-based pricing plans. Sure.
Does National General offer reference-based pricing plans? Okay.
Yeah, so we rolled out reference-based in 2017, and I've got it in 40 states right now.
Wow, cool. Okay, so then you've got some experience then with the what has been a more recent trend as far as reference-based pricing goes. Now, from my perspective, just to give you an idea where I'm coming from. So, we manage risk, we look at compliance and legal issues, and we've worked on some balance billing protection issues. So, employee gets hit with a $60,000 medical claim and they don't want to go to bankruptcy, and the employer doesn't want the employee to hurt. And so they'll bring us in to help with those issues, from a legal perspective. And in working on those kinds of cases, one of my observations has been that a reference-based pricing plan is essentially just a plan without a network. So every provider is out of network, meaning that a reference-based pricing plan absolutely positively needs, some sort of protection for that balance billing. And because most of them tend to be, actually all of them that I can think of, they're all self-insured, meaning that the state level surprise medical billing legislation isn't going to apply ever. Instead, it's got to be something on the federal level, which has stalled. And now, of course, we have both a financial and a public health crisis. So getting Congress to come back to that is going to require a lot of medical bankruptcies to be filed before they'll take it back up, unfortunately. So I'm just making an observation. I'm going to invite you to comment. This is a horrible time for people to be hit with balance bills. Sure. Massive layoffs. Price of oil went negative briefly yesterday, which is incredible, incredibly bad. So what can be done on the reference-based pricing side? Is there is this going to exacerbate things, or am I just worrying about something that is theoretical only?
No, I mean, anytime you get a balance bill, that's a pretty intense letter to open, right? When you look at that dollar figure. What I can tell you about reference-based in our experience in the small group space, and I've sold reference-based policies down to 2 enrolled. It is, again, it relates back to what works the best for the group. Education is with reference-based in particular, because balance bills can occur on any policy. On a reference-based plan, they can occur on every single claim. So when you go to the group, when we go out, or the agents and brokers that I work with, when they're working reference-based with a group, they have to be in tune with an outside-of-the-box solution. Pre-COVID, okay? If the group understands the pros and cons, here's what can happen, here's how we as National General cover, here's the pros, here's the cons, here's your loopholes. If that is something that they're interested in, no matter their affluency, whether it's roofers or a law firm, it'll sell itself, because the price is, in some spaces it's 30% lower than a traditional network option for us. If they're not wanting to go that route, or if it's just going to be too much, or it's not going to be something that works for them, it's going to work against them, I would never sell it. So we sell it on a case-by-case basis, and I think that's a big reason why our production with it has been strong, and the blowback that we've seen has been minimal. Since 2017, we've seen balance bills on less than 2% of all claims. And the majority of those balance bills have been on the small stuff. And our average negotiation price is right at 152% of Medicare. So that's why I say, I don't think it's going to go anywhere. I definitely don't, especially now post-COVID. Employee benefit costs as a business, no matter the size, it's usually line item number 1 or 2 on your sheet. With as strong as that price decrease is for that particular product, I think some groups that haven't looked at it are going to start looking at it. And I think
so let me detour here for just a second. So has the 152% mark changed recently because of the COVID-19 thing, or is it holding pretty steady for reference-based plans?
No, it's holding pretty steady. And I've heard the horror stories of, hospital XYZ or provider XYZ, they won't take it, there's no way. And we go back and we show data and say, we've had this product out there in this particular office or this provider location for a year plus or 2 years plus. There's the ask that we get on the carrier side, no matter really what the situation is, let's just say at renewal for a policy year, right? Is a group will typically come to us and say, I want the same car, but I want it newer with more features and cheaper. That's kind of the metaphor that I use.
And I want it
so
now.
reference-based is it's a tool that can get you that, but the car is going to be black instead of white, right? So, and it comes with some stuff that the group needs to be made aware of. But it is one of those things where, like I said, if the group will look at it, it'll make sense 10 times out of 10. But if it's just not something that they're comfortable with, then I've seen that turn into a really nasty scenario for everybody.
Gotcha. Wow, interesting stuff.
And you've seen some states go, like North Carolina and I think North or South Dakota, I can't remember the stuff in my head, and I believe Wyoming, all state employees are on a reference-based policy, and it's backed by Anthem. So I think it's going to be here for quite a while. And you've got other carriers starting to jump into that space. We weren't the first to invent that wheel by any means. We dipped our toe into it, and then, specifically on the level funded side, to kind of give everybody a peek behind that curtain, what reference-based does is we pay at a percentage of Medicare. So if it's inpatient, we're going to pay at 150% of Medicare. If it's outpatient, we're going to pay at 130% of Medicare. And that's why I say, like, eventually our negotiations, they're going to trend right around 152%. So in layman's terms, what that looks like is if you go in for a knee surgery with a reference-based policy it's going to be an inpatient procedure. We're going to pay the provider 150% of what they would have gotten from Medicare. Typically, in my market, Kansas, Missouri, Nebraska, the average is right around 300% of Medicare. Okay, so we're cutting it in half. Anytime you cut that in half, that corridor, that's largely a revenue stream. When you start going after those revenue streams, you're going to see some static. That static looks like a balance bill. We have language in our contracts from start to finish. If you get a balance bill, don't pay it, which I know sounds counterintuitive. But if you pay that high cost, it's going to negate any leverage we could have or would have, right? You get with us, we've got a member advocacy program set up. They run 24/7, real time, and they handle the negotiations from there. In simple terms, negotiation one is we negotiate to a price. They say yes, great, done. We'll pay them out. The member is never subject to anything more than their deductible or their out-of-pocket max. Option two is they drag their feet. We negotiate higher, and again, everything gets paid out from there. Option three is they could just say no. I've only heard of one provider system in the whole country. It's down in Southeast Georgia that's drug their feet. We went in and we did a single contract with them, a single payer contract.
That's funny because Southeast Georgia is one of the areas where we were brought in.
Yep. So it was down in Georgia. But again, it relates back to kind of everything else that we touched at is looking through the language, getting with, people like yourself, or just generalizing, making sure there's familiarity with everything, right? Because a lot of times what I see, specifically in the small group space, is we'll sell product to, Joe Schmo, who actually works for the company, but his wife is handling all the insurance, and she doesn't know what in the world it is. So we do, 2 or 3 calls with the owner, making sure that he's on board with it or she's on board with it, doing a webinar with the employees, pulling and out. I mean, we go the full deal with this particular product, just because it does have some different levers. It does have some different mechanics in the background.
Wow, cool. So I think the takeaway for folks is to be proactive, to get data, whether it's for current claims or for an upcoming renewal negotiation, to be prepared, because there's a lot changing, and I don't know that anybody's crystal ball is real clear at the moment about what the future is going to look like.
Right.
So having data and being prepared is about the best we can ask of folks right now. Awesome.
And everybody has time right now too. So pull your information, pull your policies. If there's anything you're not sure of in terms of how that language or what that means, it's like any contract. If I'm going to sign something, I want to know exactly what it is before I sign it.
Know what it says. Yep. Very good. Well, thanks, Jack. I really appreciate your time today. Folks, next week, you're definitely not going to want to miss this. So next week, we've got, particularly for large employers, and if you've got friends in the large employer space, make sure they know about this. Next week, we're going to be talking with one of the smartest people I know, Dr. Ken Wells, who is a public health expert and has worked with lots of employers across the country on medical issues and public health and workplace health. We're going to talk about what flattening the curve actually means for businesses, and more importantly, how to return to work in a safe way, so that you're not exploding your claims risk to make this 40% renewal an inevitability. So next week, we're going to talk to Dr. Ken Wells, and really looking forward to that one. Thank you, everybody, for your time today. Special thanks to our producer, the lovely and talented Ms. Kendra Lefevre. Thank you to our research team, Marcus Bahena and Christy Vanderwater. Thank you to our guest, Jack, for joining us today. Really appreciate your time. And that, as they say, is a wrap. Get it? Wrap, because we're an ERISA company. Awesome. Thanks, everybody, for your time. Really appreciate it.
Thank you.